What's going on, guys, and welcome back to my channel. Today I'm going to be answering a subscriber's question. I do plan on going back and answering a lot of your questions. Definitely feel free to leave comments and ask more questions so that I can make more videos and just be more responsive to the community in general. I really appreciate all the questions. Today's question is from Gary R. Welch, and the question is, what sectors are you looking to buy in, or are you buying the whole market? So, very simple, to the point question. So, in general, I try not to buy the whole market unless it's a leveraged ETF. But let's not talk about things from an ETF perspective. I'll get to that towards the end of the video. Let's just talk about that first thing I said, which was I generally try not to buy the entire market if I can't help it, or I guess if I can help it. So the reason for that is because I believe that putting all your money into a regular ETF, something like VOO, I think makes for a great passive investment. But for in terms of accelerating your growth every single year, I don't think it's very efficient, especially because the sectors in general, let's say of the S&P 500, the sectors of the S&P 500 are not equal, and there's definitely more weighting for some sectors more than others, and also some of the sectors may be performing better at a specific given point in time more than others. So while some sectors are overperforming, let's say this year, some sectors are underperforming, let's say this year. And the way that we tell if something is overperforming or underperforming is to compare it to the entire market overall. So, for example, on the right side of my screen, I have different sectors. On this main page of my screen, I have the S&P 500. So, within the S&P 500, there's a lot of different sectors. There's technology, that includes things like Amazon, Apple, Nvidia. There's things like consumer staples, which includes things like Pepsi and Procter & Gamble. There's industrials, which includes things like Boeing and Lockheed Martin. There's healthcare, which includes a lot of healthcare stocks. There's consumer discretionary, which includes Starbucks and Nike and things like that. So the point I'm trying to make is there's a lot of sectors within the S&P 500, and it's important, in my opinion, to take advantage of sales and maybe under or over performance at a specific point in time. One of the reasons why I like M1 Finance so much is because it kind of does that for you. If you have your pie system and let's say one of your stocks are underperforming, then your money is going to be a little bit more biased towards the areas that are underperforming, and you can take advantage of those dips. The reason why taking advantage of those dips is so important is because you get a better yield on cost, obviously. But the other thing is, who doesn't love great deals? You get great deals on great companies, and I would just really recommend buying companies that are solid, that have a really great market cap, um, you know, decent payout ratio, whatever, decent dividend yield, whatever kind of rubric that you guys want. Those are the kind of companies that I would recommend buying on M1 Finance for stock picking. If we're talking about a more kind of strategic approach to stock picking, which is maybe more ad hoc or maybe more controllable, like Robinhood, what I do is I generally scan the market. So let's take today, for example. At this very given point in time, it's May 29th, May 29th, 2019. This is the S&P 500. What do I know about the S&P 500 right now? I know that ever since I want to say the end of April or early May, there has been the top in the S&P 500, and since then we've lost about 5.8%. What I want to do now is take a look at some of the other sectors and what are those sectors doing. So let's take a look at technology. Technology, which happens to be a huge part of the market overall, and in my opinion, the market tends to follow tech. Tech in this instance looks a lot similar to the S&P 500. There's no surprise there. If I were to take a look at a company like Apple, which represents a large part of tech and a large part of the market, you will notice that Apple has also topped at this time and is showing a significant dip. Once again, Apple looks very similar to the market, and to technology in general. Let's take a look at another sector like utilities. Okay, pretty different picture. Let's see. The place at which we topped was May 24th, which was a few weeks after technology and the rest of the stock market topped. So clearly, while the rest of the stock market was topping, we had some overperformance from utilities. And that kind of tends to happen when you have extreme periods of volatility. For example, all of 2019, utilities have killed it pretty much. So the other thing about utilities that's great is that even when the market is performing well, sometimes utilities benefit. They may not benefit as much as tech, and they may not give you as much as reward as technology, but they'll still benefit. So I think utilities are definitely a great hedge, especially diversifying with a lot of utilities that pay dividends. Okay, moving on. Let's take a look at financials. So financials, once again, looks pretty similar to technology. This is going to include things like Visa, MasterCard, but mostly a lot of banks. And I'm talking like Bank of America, Wells Fargo, so on and so forth. Okay, moving on to healthcare. Healthcare is a little bit weird, and we're showing a lot of weakness here. So this is when I start to think about like, okay, what are some of the buying opportunities that are unique to certain sectors? Healthcare, while it's showing weakness, does not really inspire me all that much, because if you'll take a look at something like healthcare, and let's just very quickly go back to tech real quick, you'll see that tech made a higher high here in April than it did towards the end of October. Take a look at healthcare. The high made of October was here. We did have another high here in December of 2018, but we've been underperforming the entire time. And even over the past, let's say, couple months, we've also been underperforming. And we didn't make a higher high here like we did in technology. So in my opinion, over the past, let's say, 6 months, healthcare is showing weakness. Now the question is, okay, we know that this is underperforming. Is this a good deal right now? I'm going to be honest with you, I don't see a good buying opportunity right now. And the reason for that is, yes, okay, for the long run, clearly healthcare is down. For the long run, if I wanted to make money, sure, I'll throw a couple grand in healthcare, why not? But I mean, like, in terms of intermediate trend, what do we see here? This is the 200-day moving average. We got rejected off of it early May, and we got rejected off of it once again a couple days ago. So 1 rejection, 2 rejection, and this is after a plunge right below it. And clearly it acted as support earlier in 2019. We had a couple bounces off it, 1 bounce, 2 bounce, 3 bounce, and then boom, it's getting a little bit heavy. Eyes are getting a little bit sleepy. Eventually just plunge right through it. And this was after kind of getting right below it, try to get back above it. No, just a plunge right through it. A couple rejections later, and now this line is sloping downwards, okay? I don't want to be on the other side of that. I don't want to be bottom fishing with healthcare. So I'm going to say healthcare, let's toss it aside. What about consumer staples? Okay, consumer staples has been rallying ever since 2019, just like the rest of the stock market. However, if we take a look at how much it's retraced, it's actually not that much. We are here at the 0.236 level, and really the only consolidation that we've seen has been the past 2 days. Whereas if you guys remember, for technology, we've been seeing consolidation ever since the start of May. So consumer staples actually went on to make a higher high. Let's take a look at a stock like Pepsi. We'll probably see a similar chart. Yep, exactly. On Pepsi, we've only seen weakness yesterday and Friday. Today, we actually got a pretty nice candlestick. So this is a stock that is performing very well right now relative to the stock market. And I would try to find my bargain somewhere else. So I've gone through all these sectors. I kind of, had a sense of how the market's doing, whatever. So where are the bargains? So what do I do in the situation? The last sector I want to talk about is semiconductors. Semiconductors have been getting killed ever since April 18th. So definitely around the same time that the rest of the stock market topped. Actually, it topped a little bit earlier, sometimes semiconductors can be a little bit of a leading indicator, and sometimes whatever happens with semiconductors tends to lead the rest of the technology. So semiconductors is going to include things like Intel and NVIDIA and Micron and AMD and TSN, things like that. Let's take a look at the retracement. Wow. Do you guys remember for consumer staples, the retracement level was here at the 0.236? Here it's getting close to the 0.618, which is an ideal buy zone. Not only that, but we're also getting oversold RSI. So I'm definitely seeing more of a buy signal when it comes to semiconductors. And just in general, when we're talking about sectors, it's also important to understand strength whenever that sector is performing well. For example, on a good day, or on a good week, or on a good month, or on a good quarter, semiconductors can really rally. Same thing with on a bad week or on a bad month or bad quarter, semiconductors can drop really quickly. So clearly a lot more volatility in these sectors than something like utilities or something like consumer staples. So as someone who wants to make money short term, I'm going to always be a little bit more biased when it comes to these sectors than anything else. However, that doesn't mean that I don't find opportunities somewhere else. For example, on consumer staples, there was a period, it was actually here, all the way from January 2018 to May 2018. It was 5 months of straight dropping for consumer staples. So let's highlight that again. January 2018 to May of 2018, consumer staples went down a total of 17%. What about the NASDAQ? Okay, from January 2018 all the way to May 2018, the NASDAQ went up. So it did this drop, but it also recovered and actually made a new all-time high around that same time period. So clearly a lot more strength on the NASDAQ than something like consumer staples, where it was a straight drop. Around this time, I was buying a lot of consumer staple stocks on M1 Finance, and that's why my percentages on M1 Finance are really good for defensive stocks. So the point is, don't get too picky when it comes to certain sectors. It's okay to have favorites, but try to find bargains all across the board. So I think that's going to do it for this one before it gets too long. I do plan on having some kind of, just a general technical analysis, maybe course, or maybe just like a few videos that can teach you guys how to trade and how to get the most out of the stock market. Let me know if you guys would be interested in that. I think that my quality of making videos has improved a little bit, so I think it's better to do things like as I'm getting better in general, so then I don't have to redo them later. But anyway, it's a separate conversation. That's going to be it for this one. Hope you guys enjoyed it. I hope I answered your question, Gary, and I'll see you guys in the next one.